Hi, my name's Libby Newman and I'm an investment strategist here at Vanguard. Welcome to the Markets and Economic Update. This month, we take a closer look at interest rates and the changed anatomy of bond returns. They're simple enough dynamics. Interest rates rise, bond prices fall. Interest rates fall, bond prices rise. But as with any investment, your starting point can make a big difference. And with bonds, high yields have changed the outlook dramatically in the past couple of years. Not only is the income return from bonds much higher than 2021, but bond portfolios are also less sensitive to those interest rate movements. So bonds are less likely to post negative total returns if rates were to rise. However, we think it's much more likely that bond returns stay in positive territory, about a 90% probability, either because of continued higher income or a rise in bond prices as interest rate expectations decline. That's why we say bonds are back. Emphasising that it will be some time yet before inflation is sustainably in the target range, the Reserve Bank of Australia on 6th of August left its policy rate unchanged at 4.35%. Vanguard expects the RBA to remain on hold for the rest of the year before beginning a gradual easing cycle amid anticipated weakening in both inflation and the labour market. Meanwhile, in the US, labour market data is softening, and that triggered some volatility in early August. And the Federal Reserve appears to be taking notice of that softer labour data. The Fed gave a strong signal in July that it was prepared to cut the Fed funds rate by 25 basis points in September, a point reiterated by Fed Chair Powell following the annual economic symposium in Jackson Hole. We are anticipating an additional second 25 basis point cut this year and a target range of 3.25 to 3.5 by the end of 2025. Click on the link to read on.